They say that in the financial world there are no crystal balls. They tell you that crashes are unpredictable, that black swans appear out of nowhere to devastate portfolios and wipe out life savings in a matter of days. But what if I told you that wasn't entirely true? What if I told you that there is a signal, a siren that has wailed before almost every major economic disaster of the last 50 years? It doesn't scream from the headlines of the financial news, and it certainly isn't whispered by your financial advisor. It's a quiet, ancient signal. While the stock market parties, this signal starts to flash red. It is the silence before the storm. We are talking about the historical behavior of gold and silver. Most people look at precious metals as just shiny rocks or outdated relics, but the smart money, the billionaires, the central banks, the people who actually run the show, they view them as something else entirely. They see them as the ultimate fear barometer. When you look at the data, specifically from the 1970s stagflation, the dot-com bust, the 2008 financial meltdown, and the 2020 pandemic crash, a terrifyingly clear pattern emerges. Gold moves first, it smells the smoke, silver lags, crashes, and then explodes upward in a way that creates life-changing wealth. If you are watching the S&P 500, you are looking in the rearview mirror. If you want to see the crash before it happens, you need to look where the crowd isn't looking. You need to understand the warning signals of the metals. Welcome back. I'm the Hidden Guy, and today we are doing a deep dive into history, not for the sake of a history lesson, but to save your financial future. We are going to deconstruct the last 5 decades of economic chaos to show you exactly how gold and silver act as the early warning system for global recessions. We have roughly 30 minutes of critical data to get through, so buckle up. But before we unravel this mystery, do me a favor. If you want to stay ahead of the herd and see the signals before the mainstream media reports them, hit that like button right now. It tells the algorithm that you value truth over hype. And if you're new here, subscribe and turn on notifications. You don't want to be the last one to know when the next signal flashes red. Here's the reality we are facing today. The economic indicators are flashing mixed signals. Employment is confusing, inflation is sticky, and the stock market seems disconnected from reality. This is exactly the environment where you need a map. And the best map we have is the past. We are going to look at a specific recurring pattern. Stocks wobble, gold rises or holds value first, the gold to silver ratio spikes to unsustainable levels, and then, once the policy response kicks in, silver begins a leveraged catch-up rally that leaves every other asset class in the dust. This isn't speculation, this is historical fact. Gold has outperformed equities in 7 of the last 8 US recessions since 1971. Think about that. 7 out of 8 times, holding the metal was better than holding the market. But the real secret sauce, the thing that the Hidden Guy community needs to understand, is the relationship between gold and silver. That ratio tells us where we are in the crisis timeline. Are we at the beginning, the panic phase, or the recovery? By the end of this video, you will know exactly how to read that clock. To understand the charts, we first have to understand the psychology. Markets are not driven by math. They are driven by emotion, specifically fear and greed. When the economy is booming, greed drives capital into risk assets, tech stocks, crypto, real estate derivatives. No one cares about a gold bar sitting in a safe because it doesn't pay a dividend and it's boring. But when the music stops, the psychology shifts instantly from how much can I make to how much can I keep. This is where gold enters the chat. Gold is unique because it is the only financial asset that is not someone else's liability. If you own a bond, that is someone's debt. If you own a stock, you rely on the company's performance. If you have cash in the bank, you are a creditor to the bank. But gold? Gold is just gold. It has no counterparty risk. This is why, historically, gold acts as the fear barometer. It is the first asset to move when the smart money senses systemic risk. Imagine a theater. The stock market is the movie playing on the screen, distracting, loud, exciting. Gold is the smell of smoke coming from the projection room. The audience, the retail investors, are glued to the screen. But the insiders, the ones who know the building's wiring is faulty, they smell the smoke first. They quietly get up and leave the theater. They buy gold. This is why we often see gold prices start to creep up while the stock market is still making all-time highs. It is the divergence that matters. Let's talk about the gold to silver ratio, because this is the most critical indicator we have. Simply put, this ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this number hovered around 15 or 16 to 1. In the modern era, it averages around 60. But during a crash, during a moment of pure, unadulterated panic, that ratio spikes. Why? Because gold is pure monetary fear. People rush to it for safety. Silver, on the other hand, is schizophrenic. It is half money, half industrial metal. Roughly 50% of silver demand comes from industry, electronics and solar panels, medical devices. So when a recession looms, the market thinks factories are going to close, so we don't need silver. Silver gets sold off like a stock. At the same time, gold gets bought like insurance. The result? The price of gold goes up or stays flat. The price of silver tanks, and the ratio between them stretches like a rubber band. It goes to 80, 90, even 100. This spike is the siren. When you see the gold to silver ratio blow out, it is the market screaming that something is broken. And here's the kicker. The wider that rubber band stretches, the harder it snaps back. That snapback is where the fortunes are made. And that is what we are going to analyze in the historical examples coming up next. Let's travel back to the 1970s. This is perhaps the most important decade to understand if you want to survive what might be coming next. The 1970s were defined by stagflation, stagnant economic growth coupled with high inflation. It was a nightmare for the average American. The stock market was essentially dead money. If you put money into the Dow Jones in 1966, you had zero nominal gains by 1982, and in real terms, you lost massive purchasing power. But for precious metals, it was the greatest bull market in history. It began with the end of the gold standard. In 1971, Nixon closed the gold window, severing the dollar's tie to gold. Suddenly, the dollar was just paper, backed by nothing but faith. The smart money panicked. They knew that without a gold anchor, politicians would print money to pay for wars and welfare programs, leading to inflation. So what happened? Gold moved first. It started a relentless march upward. From a pegged price of $35 an ounce, it began to climb. By the end of the decade, in 1980, gold had peaked at $850 an ounce. That is a staggering rise of roughly 2,300% from 1970 to 1980. Think about that. While stocks struggled to keep up with the cost of milk and bread, gold delivered a 23x return. But what about silver? This is where the lag and explode pattern first became legendary. For the first part of the decade, silver trailed gold. It was volatile. It would jump up and crash down. But as the inflation psychology took hold, as people realized the dollar was losing value every single day, the public mania shifted to silver. The Hunt brothers are famous for trying to corner the market, but the momentum was already there. Silver went from under $2 to nearly $50 an ounce in 1980. The lesson from the 70s is clear. When faith in the currency is shaken, gold leads the way. It protects purchasing power first. It acts as the shield. Then, once the inflation narrative becomes mainstream, silver acts as the sword. It catches up and often outperforms in percentage terms over short bursts. If you were watching the fear barometer in the early 70s, you would have seen gold rising while politicians said everything was fine. That was the warning. The crash wasn't a sudden drop in stocks. It was a decade-long crash in the value of the dollar, and metals were the only life raft. Fast forward to the turn of the millennium, the dot-com bubble. Everyone was euphoric. Tech stocks were trading at infinite valuations. Pets. Com was worth millions. Who needed gold? Gold was trading at lows, completely forgotten. It was the anti-bubble. But right before the bubble burst in 2000, 2002, we saw the signals. The gold to silver ratio pushed toward roughly 80. Why? Because silver was weak due to a manufacturing slowdown, but gold was starting to sense the instability. When the tech bubble burst, capital needed a new home. The Federal Reserve cut rates, printing money to save the system. This brings us to the recovery phase. From 2003 to 2008, as the economy recovered and industrial demand kicked back in, silver surged about 340%. This confirms the pattern. Crisis happens, gold holds. Recovery starts, silver explodes. But the real masterclass in this correlation occurred in 2008, the Great Financial Crisis. This is the example that every investor needs to study. In 2007, the cracks were forming in the housing market. Stocks were still near highs, but gold was already creeping up. It was sniffing out the toxic debt. Then came late 2008, the collapse of Lehman Brothers. The system froze. Now, listen closely, because this is where people get wrecked. In the initial shock of a liquidity crisis, when banks stop lending to each other, everything gets sold. Even gold took a hit initially as people sold it to cover margin calls. But silver? Silver fell off a cliff. Because silver is industrial, the market assumed the world was ending, and no one would ever buy an electronic device again. The gold to silver ratio spiked above 80 again. It was the ultimate fear signal. Gold held its value relative to everything else, acting as the safe haven, while silver was discarded. But then, the Federal Reserve entered with quantitative easing, QE1. They printed trillions. What happened next? The reflation trade. The market realized the world wasn't ending, but the dollar was being diluted. Gold rallied, but silver? Silver went ballistic. From its lows in 2008, 2009 to its peak in 2011, silver exploded roughly 391%. It went from around $9 to nearly $50. If you had understood the pattern, you wouldn't have panic sold your silver when it crashed in 2008. You would have looked at that ratio spike above 80 and said, this is the signal. The rubber band is stretched. You would have bought when everyone was selling, and you would have ridden that 391% wave up. That is the power of the fear barometer. Now we arrive at the most recent and perhaps the most extreme example, the COVID crash of March 2020. This was a different beast. It wasn't a slow structural decay. It was a medically induced coma for the global economy. The speed of the drop was unprecedented. In February 2020, markets were at all-time highs. Then, within weeks, the world shut down. Look at what the metals did. Gold, true to its nature, initially dipped for liquidity, but then caught a massive bid as panic capital fled the stock market. Investors wanted the safety of the yellow metal. But silver? Silver was decimated. Since factories shut down globally, the industrial demand for silver vanished overnight, or so the market thought. The price of silver plummeted to under $12. And here is the history-making moment. The gold to silver ratio hit an all-time record of roughly 125. It took 125 ounces of silver to buy 1 ounce of gold. This was a statistical anomaly. It was 3 standard deviations outside the norm. If you were watching The Hidden Guy back then, or if you knew your history, you would have seen that 125 number flashing neon red. It was screaming, silver is too cheap. The fear is at maximum. And just like clockwork, the policy response came. The Fed printed more money in 3 months than they had in the previous 10 years. Stimulus checks, PPP loans, unlimited QE. The recovery expectations kicked in. And what did silver do? It rebounded more than 100% into 2021. It doubled in price in less than a year. The pattern held perfectly. Stocks wobbled and crashed. Gold drew in the panic capital first. The ratio spiked to a record high. And then, as the reflation started, silver began its leveraged catch-up rally. It is the same story, over and over again. The names of the crises change. Stagflation, dot-com, subprime, pandemic. But the behavior of gold and silver remains consistent because human psychology and the mechanics of money do not change. So why does this happen? Why does silver always lag and then outperform? We need to understand the mechanics so you can have the conviction to hold through the volatility. Gold is a very deep, very liquid market. It is held by central banks. It is the tier 1 asset of the world. When fear hits, big money moves into gold because it can absorb billions of dollars without moving the price too much. It is the steady, slow-moving battleship. Silver is a tiny market. The available physical silver for investment is a fraction of the gold market. So when money finally rotates from gold into silver, it's like trying to push the water from a fire hose through a garden hose. The pressure builds up and the price explodes. During the crash, silver gets hit with a double whammy. Investors sell it because they need cash, and industry sells it because they fear a recession. That drives the price down artificially low. That is why the ratio spikes. But once the recovery starts, silver gets a double boost. Investors buy it as a cheaper inflation hedge than gold, and industry buys it to restock for manufacturing. This dual demand creates the slingshot effect. The further it is pulled back during the crash, the harder it flies forward during the recovery. That is why we see these massive percentage gains. 340%, 391%, 100% in the years following a crash. But you have to have the stomach to buy when the ratio is high, when the news is terrible, and when silver looks like a dead asset. So where are we right now? As we look at the current economic landscape, we are seeing the classic signs of the wobble. We have massive government debt, geopolitical instability, and a stock market that is heavily concentrated in just a few tech names. Gold has been making new all-time highs recently. Remember the rule, gold moves first. It is sniffing out something. It is telling us that the bond market is unstable, that the debt is unsustainable. The fear barometer is rising, even if the VIX, the stock market volatility index, is low. The gold to silver ratio is currently sitting in a high range, not at crisis levels of 120, but historically high compared to the long-term average. This suggests that silver is still undervalued relative to gold. If we get another shock, a recession, a credit event, a geopolitical flare-up, we should expect the classic pattern to play out. Gold will spike on fear, silver might take a hit initially, pushing that ratio higher, and that, my friends, will be your signal. That will be the moment to remember the 70s, to remember 2008, to remember 2020. History doesn't just whisper, it screams if you know how to listen. The correlation is undeniable. In 7 of the last 8 recessions, gold beat stocks. It is the ultimate insurance. But the dynamic between gold and silver offers something more than just insurance. It offers opportunity. The next time you see headlines about a market crash, don't panic. Look at the metals. Look at the ratio. If you see gold holding strong and the ratio blowing out, you know exactly where you are in the cycle. You're standing in the silence before the silver explosion. I want to hear from you in the comments below. Do you think we are on the verge of another major crash? And are you holding gold, silver, or both? Let's get a debate going in the comment section. I read every single one. If you found value in this deep dive, please share this video with one friend who needs to wake up to the reality of the markets. It helps the channel grow, and it might just save their portfolio. Don't forget to like and subscribe for more unfiltered financial truth. I'm the hidden guy. Keep your eyes on the charts, and I'll see you in the next one.